Last week, we covered how London lease rates in both platinum and silver markets have been spiking of late, signaling tightness and even low to near no inventory in platinum. And with silver prices backing and filling this week, and lease rates having come down a touch, the opposite is true for lease rates for platinum. Longtime Japanese precious metals trader Bruce Aikemizu of Japanese Bullion Market Association posted the following on his LinkedIn today. He stated, quote, "I've been in the precious metals market 39 years and never seen this high lease rates. There seems to be serious shortage of platinum in local Zurich and London accounts. Supply-demand deficits were fueled by Chinese imports from these accounts and also shipments to CME warehouses. And the worst news is that China bans exports of platinum even if they don't need that much. Lots of businesses will have to face serious damage with these crazy lease rates." His final point about China perhaps not needing much platinum doesn't hold water when we examine platinum market supply-demand fundamentals or recent history in NYMEX platinum warehouses. China alone demands nearly a third of all platinum mined, having near none of it in its soil. Africa, specifically South Africa, then Russia is mainly where platinum ore is mined. Platinum group metals, or PGM, consuming industries like auto manufacturing, glass exports, and oil refined products. Well, China now leads the rest of the world in all three facets. And on the fact that would-be gold buyers in China are likely thrifting to relatively historically underpriced platinum versus gold for investments and for jewelry, thus we have the current setup: exploding platinum lease rates and vanishing supplies. Now, just yesterday, Mr. Bruce also opined on his LinkedIn that while both London and Zurich appear empty on supply, at least China and New York's NYMEX have inventories. Well, to his first point, China's inventory levels are opaque. As far as I'm concerned, I don't really see a lot of data on that. But on the NYMEX side, it's not really all that true. Platinum in 2025 is an 8 million ounce physical supply-demand market globally. It's tiny, something on the order of about 12 billion per year. And similar to silver, the platinum industry body, the WPIC, is pointing out platinum market supply deficits for the next 4 years is coming. And cut to the supposedly ample supply of platinum in NYMEX warehouses, having reached a recent peak of inventory near 630,000 ounces in April 2025, just over 3 months ago. Well, that supply has been reduced by around negative 55% in perhaps the last 100 days or so. That former large pile accrued during the COVID 2020 bullion squeeze to North America, well, it ended up flowing out mostly to China, unlikely to return in our lifetimes. So if the middle and late 2010s palladium market is any guide, the next source of platinum bullion rating, as the NYMEX gets depleted, will likely be unsecured Western world platinum ETFs and ETPs, the largest of which are listed here. Now, if you doubt me, try reading the prospectus of each of these respective names. In highest likelihood, unsecured shareholders in these proxies own no platinum bullion. They merely pay fees for privilege of platinum price risks ongoing. Now, you might be new here, thinking, what does this clown on YouTube know about platinum? Well, I know industry spokesbodies out of London told the world 2 months ago that platinum was forecast to average $970 an ounce this year, up 1%, supported by deficits but limited by above-ground supplies. How's that forecast working out? This is not to say platinum is going moon tomorrow, but if you actually bother to study platinum market history, its stair-step spot price reality is one of booms and busts in price action. It just simply seems we've now entered a new platinum squeeze cycle, given all the factors at play. To more generally drive home a broader perspective of tightening metals markets, TD's Daniel Gali went on BNN this week to hammer home points that metals in supply shortage inevitably need higher prices and relative values to come. Have a listen.
When I zoom out, what we're starting to see and what's really important for our clients is that every day we are inching closer to a wartime economy. Critical mineral strategy for the West is a national security strategy that is facing an increasing sense of urgency since China, to your point, issued export controls on rare earth elements. And that strategy is now fueling competition to secure resource access within the United States and within China. We've seen significant signs of stockpiling behavior, both in the United States, as traders are incentivized to rush metal in ahead of a tariff announcement, and within China with stockpiling that has strategic hues. But both of these systems are draining global inventory balances, and for many of these metals, those inventory balances have already drained below levels that are critical for the market structure. Well, metals markets in many instances are in a really precarious position because the longer this goes on, the more global inventory balances drain and the easier it is to squeeze the physical market. We're now in a position where metal that flows into the US or flows into China is highly disincentivized from flowing back into global inventory pools, whereas there's nothing preventing that metal from being sucked out of global inventory pools. This is a really precarious situation.
And of course, you've got stockpiling, artificial shortages. It's inefficient, isn't it? It creates uncertainty or discourages investment.
Right. I mean, ultimately, this is the end stage of the deglobalization narrative. Trade becomes less efficient, it becomes more costly, and raw material prices have to reflect that.
Wow. Just because countries, well, a power struggle, countries are anxious, they don't get caught short on these materials.
Yeah, absolutely. And I mean, you have to consider that the threat is strategic in nature. China has built a dominant share of global processing for many of these critical minerals. The West also fears China's resource diplomacy in that they have heavily invested in Africa, heavily invested in Latin America. And so the West sees that as a threat for their own resource access. So something, they feel something must be addressed, and this is the first stage of that action.
And part of your thesis here is that to some extent, price of commodities in the USA could become disconnected from the rest of the world.
Yeah, global prices become more disconnected. This is actually something that happens fairly frequently in commodities prices, but historically, those disconnects were arbitraged away at certain levels. The levels at which they can be arbitraged away are now significantly higher because tariffs are a very significant friction to that arbitrage. The way, or really the conclusion that we're coming to is that a world in which the trade of raw materials is fragmented is perhaps a function of geopolitical allegiance more so than market efficiency, is a world where raw material prices have to be higher, and perhaps significantly so.
It's interesting, yeah. I'm just thinking if material prices are higher in the US domestic market because of tariffs, you would think that would discourage domestic manufacturing investment.
Yeah, I mean, this is the challenging part, right? When it comes to bolstering U.S. smelter output.
Right.
There's really a limit to how much investment you can expect in the next 5-10 years. You can imagine a scenario where 30 years from now, maybe something can be done if the price is right. But between now and then, the U.S. will have to continue to import that metal. So perhaps this is really a temporary solution. If the West's critical mineral strategy is about national security, then perhaps the tariffs are really about stockpiling, about incentivizing physical traders to move metal into the U.S. And if that's the case, then perhaps that's a temporary solution until such a time that those supply lines can be deemed as secure.
In another sign that London's losing its luster when it comes to gold and silver price discovery, India's market regulator, SEBI, has recently proposed that asset management companies use spot prices published by local commodity exchanges for valuing gold and silver held by ETFs and ETPs instead of international, in other words, London prices. And while headlines of silver ETFs, ETPs getting nearly 95 million ounces of net inflows thus far in 2025 sounds large, a total of 40 billion in unsecured silver ETFs values the world over is very tiny considering the precarious state of precious metals markets looking ahead. It's not surprising that one of the fastest growing silver ETF and ETP markets in the world is indeed India. Given the current silver ETF and ETP rates of growth in India, it's no surprise that they want to keep their pricing powers more localized in the future. After all, global metals markets are signaling that is the growing trend worldwide, and India is getting ahead of the curve. We'll be right back with more silver and gold news after this quick break. Hello, this is James Anderson on behalf of SD Bullion. Smash the like button if you enjoy these bullion market updates. And be sure to visit sdbullion.com/sweepstakes to enter our free 500-ounce silver coin giveaway.
The worst day on Wall Street since the crash of 1987.
We're now down 43%.
This could be the most serious recession in decades.
Protect your retirement with gold and silver IRAs. Learn more at sdbullion.com/IRA.
The silver and gold markets were a bit mixed this week. After such a strong run in silver late last week, it was no surprise to see price action back in filling, finishing at $38.17 an ounce bid on the week. The spot gold price was up on the week, closing at $3,350 an ounce bid. Now, given gold's relative strength over silver this week, the spot gold-silver ratio climbed to 87. Now, before we leave this chart, do you see the quick spike in the gold price midweek to nearly $3,375 an ounce, seemingly out of nowhere? Well, that was a result of President Donald Trump alluding to the potential of firing Fiat Federal Reserve Chairman Jerome Powell. Now, those comments were toned down not long after, and thus the gold price receded somewhat intra-week. Trump also seemed to be confused on how Jerome Powell got into his chairmanship, stating the following this week.
He's a terrible Fed chair. I was surprised he was appointed. I was surprised, frankly, that Biden put him in and extended him.
It is my pleasure and my honor to announce my nomination of Jerome Powell to be the next chairman of the Federal Reserve.
In another sign that the current administration is in search of new pools of capital to help finance the coming waves of escalating U.S. debt issuances for years and decades to come, news this week suggests the administration is going to open up 401k and IRAs to more alternative assets like crypto, gold, private equity, and other alternative assets. It also appears the administration's Genius Act was signed into law today. It's a law which supposedly regulates, quote, payment stablecoins, digital assets allegedly pegged 1-to-1 to the fiat US dollar. And they're also allegedly backed by reserves like cash or US Treasuries. So no fiat Federal Reserve CBDC, instead regulated private ones, surely all having backdoor access from their very regulators in the US government.
This Genius Act will unlock American dominance in the crypto industry by creating clear rules of the road. It will update archaic payment rails with a revolutionary new payment system, and it will extend US dollar dominance, like you said, globally, by creating a digital dollar that people all over the world can use. And for every digital dollar in a crypto wallet, there'll be a traditional dollar in a US bank account, which will create trillions of dollars of demand for US treasuries. So that is the power of this bill, is US dollar dominance.
The fiat US dollar's final boss showdown is with gold, and it's been losing market share increasingly so globally speaking, as on net central banks continue bypassing bonds and buying gold bullion reserves in volumes never before seen on record. If gold leads in bullion bulls, white metals like platinum and especially silver, well, they eventually follow too. Here's the COMEX CME group pumping silver fundamentals this week. Have a listen.
Over the last few months, silver prices have begun to rebound relative to gold prices, but it's still been a big underperformer over the last 15 years. Back in 2011, 1 ounce of gold bought as few as 25 ounces of silver. Recently, that crossed over 100 ounces of silver per ounce of gold before coming back towards 90. So why has silver been such a big underperformer? Well, one of the reasons why it's underperformed gold is technological change. The advent of smartphones meant that people were no longer going to the shop to print out photos. Back in the year 2000, photography was using 25% of the global supply of silver. Now that's down to around 3%. But there's some really good news coming up for silver, also dealing with technological change. Solar panels now use something like 16% of world silver. In addition to that, silver is also finding use in batteries. So what it lost in photography, silver might make up in the energy transition. And by historical standards, silver is still looking very, very inexpensive relative to gold.
Now, what they fail to point out in silver's ongoing demand factors is hidden under the, quote, other uses category. Now, instead of risk-laden levered proxies like silver futures that you might want to trade in and lose all your funds on a short-term basis, you could simply buy the real things with silver bullion as you await the coming investment demand waves, mostly driven by the USA and India to come. Now, throughout this full fiat currency era, the trend has been simply that gold leads laggard silver, and later in the bullion bull market stage is a furious rally in silver outperforming gold akin to what it did in the late 1970s and post-2008 global financial crisis runs. Ongoing varying gold, platinum, and silver bullion allocations in this current world all make sense with varying timelines associated. For myself, it's the closing of the silver versus gold gap reoccurring that has me still stacking silver bullion regularly given how relatively cheap it remains amongst anything you can name. Take advantage of silver coin at spot deals this weekend while supplies last at sdbullion.com. That's going to be all for this week's SD Bullion Market Update. And as always, to you out there, take good care of yourselves, those you love. If you enjoyed this video, hit the like button and share it with those you love. Subscribe to our channel and hit that alert button so you know when we publish new bullion market updates.